Now, of course, for our happy panelists, that means their words about to be inscribed in the hot metal of the internet on YouTube, forever collected for posterity, for future views. If you want to search for this webinar afterwards, you simply go to YouTube and search under the title of the webinar, or go to the Climate Bonds YouTube channel. It'll all be there. Free to view, available for download, and most importantly, available for sharing with your friends who are really, really going to feel bad they missed out on this fantastic webinar we're about to launch into. And now, Louisa, you'll tell me when I can go in terms of our numbers and participants.
We are up to 140, so I think you're good to go, Sean. Good luck, everyone.
Thank you, everyone. Hey, I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. Big surprise there. I'm here to talk to you about sustainable debt and the North America state of the market, or really just to introduce our fantastic panelists. We have a dream team. We've got Bradley Comendo, who's Portfolio Manager and Deputy Director of Investment Grade Corporates. What a title, at Amundi Asset Management. So he's going to talk a little bit from the investor perspective. We have Lisa Bozelli, if I've got the pronunciation right, Lisa,
sure.
Who's the Senior Director, Multifamily Capital Markets of Fannie Mae. If you don't know this, you should know this. Fannie Mae is the world's largest green bond issuer in terms of volume of investments, volume of issuance. So there's a story there. We've got Michael Brown, who's the Environmental Finance Manager, or Mike Brown, really, the Environmental Finance Manager of the San Francisco Public Utilities Commission, that's been a long time issuer of green and certified climate bonds. We'll talk about their story, especially the resilience angle, Mike. I want to hear about that. Adaptation measures. Patrick Misbagel, who's from the Global Head of Sustainable Finance at Moody's ESG Solutions, who will bring a sort of system architect perspective. And then we're going to kick off with Caroline Harrison, who's co-author of the report and research analyst, a long and incredibly dynamic research analyst for the Climate Bonds Initiative, who's done lots and lots of reports, including pricing. Have a look at our pricing reports. They are gold. Of course, you know what this is about. At the end of the day, we have enormous challenges around climate change. We are feeling the impacts way faster than anyone thought we would. I mean, these heat incidences in the Northwest, in Canada, yikes, that is unbelievable. I was listening to Michael Mann, a well-known climate scientist, yesterday, saying that these are 1 in 200,000 year probability incidents that are now becoming 1 in 1,000 year, possibly 1 in 100 year incidents. Like, that is a symptom of climate change. This is not normal, folks. It is not normal. And the kind of impacts we're seeing with wildfires raging in Northern California as a result of those heat incidences are what we're going to experience more and more. Of course, it's all related to the warming of the Arctic, and there'll be flow-on effects, the drying out of the Amazon. All this is happening in real time. We expected it to happen in 2030 to 2040. Yikes, have we got a problem? What the Intergovernmental Panel of Climate Change says to us is we have to get emissions down globally by 55% to have even a reasonable chance of creating a sustainable future for our children. That sustainable future, by the way, doesn't avoid the volatility that comes with climate change. We have a whole lot of climate change baked in. The last 30 years of warming will take 30 years to play out. We're going to see a lot more wildfires. We're now in a race to avoid catastrophic climate change, the kind of climate change you do not want your kids to live in. You do not want future generations to have to deal with. It's ugly. It's very ugly. It's, you know, let's just say catastrophic is not a good future for the human species, and all the species who travel with us. Now, of course, we've had some fantastic wins in the last few months. At the Biden Climate Summit, we saw country after country after country make announcements about 2030 targets for reducing emissions, exactly what the IPCC ordered in their 2018 report. Now, no one really knows how to do it, but that's not how we deal with stuff when it's coming over the horizon. We've got to act fast. We decide what we've got to do, and then we marshal forces. We're in the process of marshalling forces right now. The good news is we do know what to do. Sure, we haven't been doing it enough. Well, actually, we're doing it in energy. Solar is becoming so dirt cheap that in a few years' time, there will be no point in doing anything else other than solar or wind because the cost reductions we're seeing. They're pricing out gas already in the US. Fossil fuel is a goner in terms of the future. We're seeing changes in electric vehicles. It's not just Teslas, which are fantastic. It's also the whole Chinese government pushing to transform its transport infrastructure into electric. From in Shenzhen, city of 20 million people, every single taxi and bus is electric already. So these changes are very positive, but there's a lot more to be done. Governments are going to act. There is progress. The European Union, for example, has rolled out a really exciting action plan on sustainable finance last week. Have a look at the blog coming out from us in the next few hours, and you'll see a encapsulation of that, including things like guidance for what counts as a Paris Agreement investment. So there's work happening. We know what to do. It's going to take a lot of capital. It's going to take, something between 70 and 90 trillion dollars. The US GDP is about 17 or 18 trillion dollars as guidance. That's a lot of capital. But you know what? We are lucky. I know it's absurd to say this, given what I've just said, but we have the capital. We are swimming in underutilized capital on this planet. Big slabs of it are invested in German or Japanese government bonds. Do you know they pay a negative interest rate? Negative interest rate. We pay them to look after our money. That is no way to pay the pension of our panelists. We need to put that money to work, and that's going to go in climate solutions. We have the solutions. We have the capital. We've got to make the money flow. We have a proof of concept. Sustainable debt markets. They prove that if we get the deals out there, investors will fall over themselves to invest. Well, at least that's what I'm saying. We'll have to see what Bradley says later from Amundi and whether he agrees with that proposition. Now I want to introduce Caroline, who will give you some highlights of the report for PowerPoint presentation. She's about to load. I'm filling the gap while you load it, Caroline. And then we'll turn to our panelists who will discuss the issues and we'll take questions. There's a Q&A button at the bottom. Do ask questions. We'll respond to as many as we can, not all of them, except we will be typing answers and we'll try and pick up some afterwards if we can't respond verbally. So ask questions. You can download the report. One of our team will be putting a link to download the report in the chat box any minute now. Keep an eye out for it. Read it. Fabulous report. But above all, remember, it's our job, all of us, to get the deals flowing that will achieve the future we want. More to be done. Over to you, Caroline.
Thanks, Sean. Okay, so my name is Caroline Harrison. I am a research analyst at the Climate Bonds Initiative, and together with Leah Muting, I am the co-author of the report that we will talk about today. Oops, sorry. Sean has already introduced our panel, and after this presentation, Sean will moderate a discussion which will include questions. So if you do want to ask a question, put it on the Q&A. I will be monitoring that throughout the rest of the time that we are here. So our North America State of the Market report looks at the shape and size of the US and Canadian green, social and sustainability bond markets. And we go to the end of the first quarter of 2021. So at the end of that period, North American sustainable debt market had reached a total of $311 billion. 87%, or most of that volume, was green, and the remaining 13% comprised social and sustainability bonds, which are small but rapidly growing segments of the market. US entities have to date issued $275 billion worth of green, social and sustainability debt, and Canadian entities have issued $35 billion. The full research paper includes analysis on the shape and size of these markets by theme, maturity, issuer type, currency, tenor, and size of individual instruments. So if you want to know anything about these markets, please read the paper, and it's all in there. So just to put into a global context where we are at the moment in North America, supranationals were responsible for the most amount of GSS debt, and a lot of that comes from sustainability bonds. The USA is the largest individual country source, and Canada ranks 10th. Now, US market volumes have been heavily supported by the efforts of one individual issuer, and that is Fannie Mae, which at the time of writing this paper had printed green bonds worth $94 billion, or equivalent to more than a third of the green, social and sustainability total volume printed to date from the US. So without that support, the US would rank behind France and China and would take 4th place. So today, as Sean has already noted, we are very lucky to have Lisa Borzelli on our panel from Fannie Mae, and Lisa can share some of her experiences later during the discussion. And please take this opportunity to ask Lisa any questions about the experience of issuing. She has decades worth of history in this market and tried and tested many different things. So take advantage of that, please. So for the sake of transparency and integrity, green, social and sustainable debt issuers commission something called an external review on the credentials of the use of proceeds before the bond is issued. So this enables investors to assess whether the instrument complies with expected standards, and also to determine whether the instrument falls in with their investment objectives. So the share of instruments without an external review is decreasing, but nevertheless, you can see from these red tips here, particularly in the US, that there still are instruments that are coming to the market without an external review. So among the top 10 issuing countries, third-party reviews are the least common in the USA, with at least 27% of annual issuance volume not obtaining a review. Financial corporates had the lowest share of volumes at 44% not having a review, so that is quite high. So this is something that needs to be worked on if we want to grow the market, which is maintaining the integrity of the green label. Our paper also has a section on post-issuance and impact reporting, which overall was found to be improving in both the US and Canada. There's more detail about that in the paper, of course. So as well as looking at the shape and size of the current market in the paper, we've also spotlighted key themes that could have a substantial impact on growth dynamics moving forwards. The first of those is the energy sector. Both the US and Canada still rely on fossil fuels for most of their energy, and renewable or low carbon alternatives are available, as Sean has already pointed out. So the phase out of coal, oil and gas is well overdue, and this has to be driven by strong policy support. So sustainable debt markets can support this transition, and particularly now the development of new instruments and labels will help with this, and those include things like sustainability linked bonds and labelled transition bonds. So transition financing is intended to sort of broaden the scope of industry sectors that can get involved in the collective decarbonisation effort and use the debt markets to help with that. Our second spotlight is focused on securitisation. So the securitisation market in North America was 12.7 trillion at the end of 2020. So we see this market as being ideally placed to support the transition to a net zero economy. And there are several areas in particular that have potential expansion, and those are listed here. So zero emission vehicles, PACE, solar and SMEs. And again, we've gone into more detail about that in the paper.
Can you explain what PACE is, please, Caroline?
Pardon me?
What's PACE?
PACE is a type of loan that can help with energy efficient improvements to houses. Property
assessed clean energy bonds. But
exactly.
Thank you. Just because no one will know. And SMEs, of course, small and medium-sized enterprises.
Yeah, exactly. So finally, our work on green bond pricing in the primary market looks at the pricing dynamics of the largest and most liquid bonds, and includes a sample of 56 bonds from North American issuers issued since 2016. Within the paper, we home in on the results of those particular bonds to see if we can determine anything about whether or not investors attach a value to the green label. So broadly speaking, the pricing dynamics for green bonds are strong. The book cover and the price tightening is stronger when compared to vanilla equivalents. And just 22% of the sample, so that's about a fifth, has a normal new issue premium. The rest price either on the yield curve or inside the yield curve. So those are the bonds that we've looked at from North American issuers. In the secondary market, green bonds tend to tighten more aggressively when compared to corresponding indices or vanilla equivalents. So we see value there for both issuer and investor. And if you do want to know anything more about green bond pricing in the primary market, we have written 11 separate papers on this subject, and there is a strong summary inside the North America State of the Market. So we need to scale up this market. This is a very simple slide with a very strong message. So at the moment, or at the end of the first quarter of 2021, total GSS debt from the USA constituted 0.6% of outstanding debt, the local bond market. And for Canada, that figure was slightly higher at 0.9. So there is plenty of scope to fill the bond markets with bonds which have a use of proceeds that are considered to be climate friendly. So there's room there for growth. The 6 items that are mentioned on this last page are areas that we think should be focused on in order to develop the market. And policy can, of course, be developed to support these imperatives. So they're all fairly self-explanatory, but first and foremost, the USA must follow Canada's lead and announce a green sovereign. They must incorporate green bonds into their public debt programme. Climate Bonds has recently published the results of a survey in which we spoke to all of the sovereigns who have issued green, social and sustainability debt to date, in which the numerous benefits were uncovered and discussed. And I'll actually put a link to that in the chat after this. Secondly, a broader range of issuers will help to engage a higher number of high profile investors, which again will put pressure on policy. Thirdly, whole entity transition plans are needed to enable participation from a broader range of sectors and issuers to enable investors to build diversified bond portfolios and spread other types of risks. Fourthly, benchmark size deals with adequate transparency will help to get the market going by attracting dedicated mandates. And further, the more benchmark deals that come to the market, those will be included in broad market non-green indices, and that will help to involve many more investor types in the growth of the market. Fifth, repeat issuance brings scale economies to both issuers and investors and is absolutely essential to ensure a steady pipeline of GSS bonds for investors in this market. And sixth, and finally, and I can't stress this enough, but clear, accessible and consistent pre- and post-issuance reporting supported by wider use of third-party reviews will also support investor confidence in the credibility of the GSS theme. So these are the things that we think should be focused on in order to grow the market. So this overview has been very brief discussion of the content of the paper. And I will now hand back to Sean and we will hear the expert opinion of our panel members, and I will monitor the chat during the conversation. Thank you.
Thanks, Caroline. Very good, very useful, and congratulations on getting the report. I know it's been a huge job. Bradley, can we start with you? As I said before, give us your take, your perspective, and of course, explain a little bit about Amundi, one of the world's largest asset managers, and your thinking about this market and what you see happening in the future. Over to you.
Absolutely. Thanks, Sean. Yes, well, Mundi's have a long history, I would say, of a focus on sustainable and responsible investing. So maybe I'll touch on three topics quickly. One would be the demand. And so obviously we offer a lot of mutual funds, but we have a lot of institutional business as well. And in that area, we see a lot of clients. So these aren't necessarily new mandates, but existing clients that have just had a generic benchmark, but are now asking us to provide a solution that addresses these issues, whether it be a beat the benchmark in terms of a higher ESG scores. Some clients could be focused on governance issues, but more and more we're seeing climate focus and carbon reduction targets, and again, measured against the benchmark. And so we're starting to see more and more of a push. And I would also say on the new business front in this area, the vast majority of new mandates, especially coming out of Europe, really have some sort of a GSS focus to these mandates because the clients want these better solutions. And the second part would then be, well, why do they want these solutions? It's for a couple of reasons. One, I think they view these outcomes as being better outcomes. They want to promote the sustainable investment approach, but it's also regulatory. So as an outreach of the Paris Climate Accord, we developed in Europe initially Article 8 compliance, which was around our overall approach toward ESG and how we treat products from that standpoint, really putting an emphasis now on ESG considerations for investment products. Now moving towards Article 9, which really starts to address the climate aspect of it and these carbon solutions. So that's really what's been pushing it. And I would say if we go to the US side of things on the demand front, we're a little bit behind because for a while we'd exited the Paris Climate Accord, but re-entering it early this year, it's just a matter of time till the US starts adopting the same legislation. And so we see a situation where there's going to be enormous demand for these type of bonds and for these strategies. And I would say overall in terms of the market, we've done some research, the products that are out there probably in sum total are less than about $50 billion of sort of dedicated strategies when we're talking about $39 trillion of total debt outstanding. So the opportunity is enormous from the market standpoint. And I think we're going to see a lot of product launches. I know certainly at Amundi here, we're in the process right now of evaluating how we're going to approach our solutions and strategies, but you're going to see the whole market really start to address this as a consideration. Maybe one final comment, I think there was another slight derailment in the market was, for those that aren't familiar, there's what's called the Department of Labor rule, where you couldn't consider ESG factors or climate or other types of things when investing assets in an ERISA portfolio. And that was something from the previous administration that is now under review. And we think it's highly likely that that will be removed. And then suddenly the market is going to be opened up to a lot of additional investors who are going to want these responsible investing solutions, especially as we look at municipalities and other large plan sponsors from their own governmental aspects, trying to deliver on these sustainability goals. It makes sense they're going to implement them in their products as well.
Thanks, Bradley. Interesting point about that. One of the little known bits of political history is that in 2008, in November, after the election, the Bush administration also pushed through changes along these lines, not quite as strong as ones. And they didn't actually have a major impact because investors, when they started thinking about their risk analysis, just said, it's risk, it's risk, it's risk. And we moved on. I mean, hopefully that was the case, the impact, but the fact that the Biden administration is reviewing them is very important to make it clear and explicit the need to address broader risk factors, which of course, Patrick's going to talk to us in a minute. But first, I want to go to the heroine of the market, Lisa Boselli, whose organization, Fannie Mae, hey, it is an elephant of an organization, Lisa, but you've done a fantastic job of growing a green bond market in relation to multifamily homes. Can you tell us your story, including touching on the investor appetite questions that Bradley was picking up? Please.
Sure. Thanks, Sean. As Caroline mentioned, Fannie Mae has been in the green bond market for over 10 years now on the multifamily side. And so we've issued over $95 billion of green multifamily MBS to date, primarily through two programs, either a green building certification or an in-place renovation program called Green Rewards, where we focus on energy and water consumption reduction improvements. So in addition, we have continued to grow into our single family residential business, which if anyone is familiar with Fannie Mae, is much larger than our multifamily business. So we issued over $1.4 trillion in single family general loans last year, compared to the 75 billion of multifamily, just to give you a sense of where we fit in. But single family is a much larger market, but it's also has its own challenges because we are talking about residential rather than commercial. I did want to talk, Sean, a little bit about what you had said about scale. So we get a lot of questions about how to scale a program. And I think we're all involved in macro conversations about how to adopt standards, set data and disclosure requirements. Here in the US, there are a number of trade organizations setting up sustainability committees and ESG working groups. In our sector in particular, Structured Finance Association, the Commercial Real Estate Finance Council are a couple of examples. But in looking at that, that's a much more macro issue, and that involves elements outside of our individual issuer control. So what I really try to tell folks that are looking to issue green and social bond programs is to focus on the program themselves and what you can control. So for example, I have 3 primary points. One is to build it with impact in mind. As Bradley mentioned, impact is really at the end of the day what we're here for. What is the impact of your program? How are you going to quantify it? What data fields are going to be available or are available, frankly, because the going to be available isn't going to help you today set up that program. At some point, you will have to issue an impact report if you're going to be in compliance with the green bond principles. So we just issued our 3rd green bond impact report, and it's a heavy lift. So you need to know that as you create your program, what can you do to make that easier for you and better for your investors in the long run? Secondly, I would say the big thing is aligning incentives of all involved parties. So we're a little different from corporate debt in that, in the world of mortgages, mortgage-backed and asset-backed, we need those individual borrowers to commit to make those improvements. So we're not a direct lender. We need to get the lenders involved. We need to get the borrowers excited and willing to do the extra work. And in order to do that, you do have to think about how you're going to be able to align those incentives, whether it's a regulatory incentive or a financial incentive. At some point, that's got to be part of your framework. And then lastly, I think you have to build it in a way that encourages adaptation. So you have to try to make it fit your existing processes. When we first began with the property energy audits, they took way too long for a mortgage underwriting process, so it wouldn't work. You have to remove those impediments. We had to partner with the energy auditors. We have to make it work. And then you have to make sure it's familiar and painless. You have to attract those borrowers to grow the scale. So those are our 3 bits of advice, I think, for folks looking to scale their program. And then lastly, Sean, I would address for investors, it's been a huge difference. It used to be we would go to meetings and folks are very interested in hearing about agency CMBS and not as interested about green. And it's had a complete reversal in the past 18 months. Now we've got a lot more investor participation or interest in the deals, but it's coming up the education curve. Folks are trying to figure out what standards exist. We are looking to the EU taxonomy and to ICMA's green bond principles and social bond principles to say, hey, there are processes established already. These are what they mean. This is what a labeled bond program means. And folks are very, very keen to understand it. And also to Bradley's point, to find the collateral, whether it is in a labeled bond program or not. In fact, Sean, I would put it back to you. You guys just published an article about finding hidden gems. We're seeing a lot of that in folks trying to parse through existing securities that are not labeled, but that do have some kind of ESG requirement that meet their requirements for their program.
It's interesting, and you've had a lot of experience in doing this. Just a question, because we're getting quite a few questions about how to avoid greenwashing, which I'm sure all the speakers will tackle as they go on, and particularly Mike next, who I know has been thinking about it. In your program, because you're dealing with slightly arm's length with the end investment, is this an issue for you? Have you ever found it a problem with just making sure that the claims stack up at the end of the day? And does your verification process, have you ever had any hiccups, is what I'm trying to ask?
No, definitely. And I would say, we had the great good fortune of having to do this when it was still dark and no one was looking, and you could experiment with programs, and they failed, no doubt. And I think, unfortunately, folks that are coming to the market now don't have that benefit. Everyone is looking at you. But on the opposite side, you now know that, hey, if I have a framework, if I have a second party opinion, I have done what I can. Other eyes are looking at the structure of my framework. But yes, I would say the rigor, and one of the reasons that we're not seeing a lot of other non-agency folks in the CMBS market enter this market is it requires a huge commitment. Our asset management group does a lot of work to make sure that the rigor of, the correct toilets and the correct light bulbs are in there and working and functioning as they should be. So yes, very sensitive to the greenwashing concept, both in terms of issuance and in terms of investors, looking to find the green bonds that are out there.
So for our listeners, there is work to be done, and to ensure there's confidence for the part of investors to make sure your program works. But of course, Lisa, I guess it's a fair thing to say this is necessary work anyway going forward. So it's not like you have to invent a whole new program. You just got to get the program right. Is that a reasonable
Right.
comment to make?
Yes, and you have to find a way to get people to make these improvements and to move the market forward.
Thank you, Mike. You've been at this for a while now, and you've in a different area, water infrastructure. Tell us a bit about your experience and what the issues that come, and also what you're doing.
Thanks very much, Sean, and for having me here today. Sure. First, I might just talk about the muni bond market very briefly, because talk about hidden gems. Lisa mentioned, you mentioned the U.S. muni bond market for folks that don't know is about a $400 billion a year issuance, and a very small percentage of that is labeled green or social or sustainable. Maybe less than 10%. But if you think about the kinds of projects that are being financed with these bonds, it's rail, it's green buildings, it's water infrastructure. The vast majority of those bonds should be green bond eligible. So I think there's a massive opportunity there. It does, I think, largely come down. We actually did an informal survey to issuers here in California, and a lot of it comes down to issuer capacity. The other feature of the US muni bond market is that it's very fragmented. There's tens of thousands of individual issuers with varying degrees of experience and capacity and resources. So I think once, perhaps if there's some coalescence around a standard, a reporting, it may help. Also, once folks see a pricing benefit that they can count on, I think that will also push folks over the edge to jump in the market. But I just wanted to start off with those couple points.
Mike, are you seeing that pricing benefit yet?
We are absolutely seeing a pricing benefit. We are selling both taxable muni bonds, because the refunding bonds need to be sold on a taxable basis currently if they're an advanced refunding. The rest of our bonds are tax exempt, but now with both tax exempt and taxable, we're seeing a pricing benefit. A larger benefit on the taxable side because it's a larger investor base, more demand there, but yeah, we are. Even during this.
After covering your costs for the program, are you ahead or are you breaking even?
Yeah, the cost, I mean, that's also something that people, I think it costs a lot of money. It does require some resources, but it is not expensive to get a third-party verification and the staff time. A lot of the data is already there. Like in California anyway, we have to do something called CEQA, these environmental impact reports. A lot of this analysis is being done. It's just a matter of, daylighting it, making sure, it becomes accessible to investors and, to the person doing the entity doing your third-party opinion.
I just want to check.
So we are ahead for sure.
I just want to check with Lisa about this pricing issue. This Fannie Mae said, now I want to stress, in a survey we did last year, that Caroline did, in fact, of looking at issuers around the world, we had a lot of people in hard currencies reporting a bit of price differential appearing, but none of them said they were doing it for the price differential. They said they were doing it for the investor engagement, the deeper relationship with their investor base, just as a caveat for everyone to understand. However, in the US, we do get asked this question all the time. Lisa, is there anything to report on that issue, putting aside the investor relationship from your perspective?
Sure. I think we can't even agree internally if there is a greenium for the green bonds. I think on the multifamily side where we've been doing it, and you can see our bonds trade, just as an FYI, our bonds are individual loans for apartments backed by one MBS. So they trade on a daily basis. There are so many components to an apartment in New Hampshire versus an apartment in California that it's very hard to differentiate whether that difference is the green nature of their financing. What we do see on a larger, when we do the larger GEMS deals, is they're stickier investors, right? They really want that bond. It is a green bond. There aren't that many out there, so they are stickier when we do try to tighten spreads. Now, on the single family side, where we've only issued slightly over 200 million out of a very large, trillion size market, there has been a definite premium pay up for those. And so I think that's a double-edged sword, because it's great because we obviously would like to have a benefit to the program. But on the flip side, some folks are looking at the labeled bond program as more expensive or too expensive. And then we're back to the point of, how do I find unlabeled opportunities, because they are cheaper.
Great points. This is very interesting developments, and the stickiness of investors. I mean, that's gold dust just in its own right. Mike, no? Back to you.
Yeah, no, definitely. If an investor has a mandate to buy green, they're gonna buy it. Even if they have to pay up a little bit for it. I think in the U.S. and among munis, why the pricing benefit is such a key question is because we as public employees have a fiduciary responsibility to get the lowest cost of debt. So if there's an opportunity for us to lower our borrowing costs by having our bonds labeled, I think that kind of requires folks to take action, and I think that's why that comes up so often. But we unlike Fannie Mae, we are able to do pretty well, able to do apples to apples comparisons. So a green, non-green bond financing, very similar infrastructure. So we've been able to demonstrate pricing benefit that way.
And what are you financing? Give us a taste.
We're winding down now an upgrade to our water system. So we're in San Francisco. Our water system actually begins in the Sierra Mountains in Yosemite National Park, and the water flows for about 200 miles down into the peninsula south of us. And so there's pipes, there's tunnels, there's dams, there's all kinds of assets, treatment plants. And we also, we serve San Francisco, which is about 750,000 people, but also our total service area is about 2.5 million people. So we serve our surrounding counties as well. So Silicon Valley, Google, Apple, all those guys take our water.
And most people think mitigation and reducing emissions or other kinds of environmental benefit. And of course, that's the core part of Fannie Mae's program, although there's other aspects like water management there too. But you've got a very strong adaptation and climate resilience feature to your thinking about assets, right? Can you just tell us a little bit about that?
Yeah, that's right. I mean, we've done a lot of analyses. This is both on the water supply side, but also on the stormwater management side, because rainstorms are more frequent and more intense. So it's kind of both. We operate both systems. So it's coming up where we have to build kind of.
We've lost him briefly. Okay, we'll move on to Patrick and bring Mike back a little later. So, Patrick, tell us a bit about
water to account for. Oh, did I lose?
We had an outage, Mike. We'll come back to you.
It was a great point.
Patrick, you're one of the Arctic system, but what I'm keen on you telling us is not only your prognosis for the market and what you're seeing in trends, but also the journey that you've been on in Moody's over the last few years, where there's been a lot of developments, right, about integration to credit ratings, about risk and so on, and of course, providing services to the green bond market. Tell us the story.
Sure, and I'll give a little bit of background. And first of all, congratulations, Caroline, and your co-author, and thank you, Sean, for having us here. We're really delighted to join Amundi in co-sponsoring this research, which I think is groundbreaking and so important in terms of raising visibility and deepening, I think, dialogue with investors and other market participants. Sean, as you allude to, Moody's has been on a long journey related to ESG. And for those of you less familiar with Moody's more broadly, certainly Moody's Investor Service, the rating agency, is perhaps best known, but we're divided into several businesses, including Moody's Analytics, of course, MIS, and Moody's ESG Solutions, which I represent here today. Across our businesses, we really are focused on offering solutions and supporting customers and market participants as we look at the greening of the economy, focusing on strategic resilience and responsible capitalism. And there's a slightly different flavor or twist depending on which part of the business. Certainly MIS focused on the credit ratings, and for quite a few years now has incorporated ESG factors in credit ratings, in the credit rating process. That's become increasingly formalized in recent years as the market's appetite has grown for greater clarity and specific understanding of how ESG factors, whether it's risks or opportunities, do contribute to credit quality. Moody's ESG Solutions, interestingly, while credit markets are certainly part of who we serve, and we'll talk about sustainable finance here and our second party opinions, and in particular, it also has a broader set of customers, including equity and risk management. So Moody's ESG Solutions, we're organized into 5 businesses: ESG measures, climate solutions, SME solutions, indices, and then sustainable finance, which is who I'm proud to represent today. But cutting across those, there's some common values that we look at, including this notion of dual materiality and really taking into account not only the financial impact of ESG factors, but balancing those across a broader set of stakeholders, employees, the environment, supply chain. So credit is certainly, part of the element of what Moody's ESG Solutions does, but it is a broader view that we take.
It's complex. And of course, this is the thing about ESG, isn't it? Multiple data points gives you a better chance of understanding what's going on in all this. Of course, the green aspect is becoming a kind of different kind of data point. What we see happening around the world, well, at least we're seeing, and I'm interested in your take on this, Patrick, is that a green universe is seen as now a low risk universe, less likely to be impacted by policy changes. And perhaps that's what's driving the secondary market performance, that's driving the price benefit we're seeing. I don't know. What do you think? I appreciate the metrics to bring it into the credit rating are a bit challenging. We don't have the history, we don't have the visibility, but
Sure.
Is it a reasonable argument to make?
Well, I mean, I want to first sort of touch on the point you made about data. I mean, I think that data is central and fundamental to all of what we're doing across not just Moody's ESG Solutions, but certainly MIS, the rating agency, and Moody's Analytics. And I think that's been one of our primary priorities in investing is really helping to bring that data to the market in a way that is usable and clear. And I think with greater disclosure and increased standardization of disclosure and increased transparency, not only through providing second-party opinions and sustainability ratings and so forth, that will become that much easier for the broader market, not just for those of us that are looking specifically at risk. But your question, if you could repeat your question again, Sean, about the greening.
Look, this is the idea that the green bonds universe is a way of identifying issuers, companies, entities who are taking steps to achieve change and therefore present a low risk. But let me ask you a different question that arises from that, which is we have in the US a rather changed political environment this year. And we also have some changes in Canada, where Justin Trudeau has come to the Biden Climate Summit on 22nd of April with a strong statement of 2030 ambition, a bit like what the Biden administration has made, and so on. How do you see the political changes, speaking of policy risk, speaking of people staying ahead of these risks, impacting on the Muni Green bond market, the Canadian bond market? Notice that Canada's coming to market with a sovereign bond in the near future. What's the impact going to be? Is this real or is it window dressing?
Well, I think, and the report does, I think, a beautiful job of summarizing some of the key developments and changes since Biden took office, and it's a pretty diverse range. I think touching most parts of the government. I mean, from legislative priorities with the infrastructure bill, certainly being a stimulant, if you will, to investment that I think could likely have knock-on effects for munis at the local level, supporting further growth in the sustainable bond market, as various levels of government seek to invest in either upgrading and improving infrastructure or focusing on mitigation, which to me is something that's near and dear to me, being from Northern California myself and seeing my parents live through some of the fires. So but more marquee developments, including re-entering the Paris Climate Agreement, the pledge to cut emissions by 50% by 2030. So I think also looking at regulators, the SEC, and various initiatives on climate and ESG disclosures, certainly I think is responding not only to the changes in the political climate, but also I think the global appetite among investors and the investor base to have greater transparency and consistency, so that as they do make investment decisions, they have the benefit of comparability, and they have the benefit of understanding, comparing apples to apples, which is no small feat. And so, I think that these are important developments, but I do think it's important to acknowledge, especially in the United States, that there were changes afoot before Biden took office, and certainly if you look within the state government space, U.S. states, roughly half of them, have economy-wide emissions reduction targets in place. So important developments. To me, it's a very exciting time to see the tone and the change of focus in the U.S. And I do think, certainly as we look at the volume of sustainable bonds in the U.S., it's been an extremely busy year for us in terms of looking at the volumes, and also seeing greater innovation, looking at sustainability linked bonds and loans. So I do think that we will start to see greater deepening, and hopefully with that will come greater disclosure again, and availability of data for those of us who are assessing risk and looking at providing that comparable view and opinion in the market.
We've seen Bradley, a question for you. Thanks, Patrick. We've seen a pretty large growth of this market organically in terms of benefits and investors doing it. But of course, in Europe, we have this discussion. Just in the last week, the European Commission has announced a whole new raft of measures. I'm sort of curious to see whether you think these might become part of the agenda in the US. I'm going to take two. We've had Europe announced a refreshed look on risk weighting differentials in the capital ratio requirements of banks. So they will get effectively a higher leverage ratio of the whole green bonds on their balance sheet, which is what has been talked about for some time. In fact, the Hungarian central bank of all central banks is trialing this with property green bonds already. We've also seen an announcement by the European Central Bank around a raft of climate incidents. And a few weeks ago, we saw Jens Weidmann, head of the Bundesbank, say they now supported green quantitative easing, which Christine Lagarde's been talking about. Whoa, these are pretty amazing developments in the European market. Can you see this happening in the political environment in the US, maybe even Canada going forward? What's your reading?
Yeah, I think absolutely. I think from the issuer standpoint, that's where you'll see a lot of, I don't want to say regulatory pressure, but a different approach. And I think, in the US, where we have 6 or 7, top 10 banks have a huge market share of the banking industry in terms of lending to consumers, there has been pressure we've seen from a legislative standpoint to address some of these shortfalls that the banks have in terms of their social partners, in terms of the access to capital, access to borrowing. And there's going to be much more focus, I think. So from that standpoint, that's not about them issuing social or green bonds. It's going to be more just about their underlying business model having to be adjusted to generate better outcomes in terms of the society as a whole. So I think that for sure is going to be an issue. And then I also think on the issuance side, I think we are going to see a big shift with the current administration. And I think the other thing to point out is that, the previous administration sort of backtracked a lot of forward movement momentum, I would say, with this initiative. But that was just the administration level. I think society as a whole in the US is shifting more towards this understanding the importance of responsible investing. At your point, state and municipalities have really already put forth a lot of goals. So the inertia, while from a regulatory and administrative standpoint slowed down, I think we're going to see a significant reacceleration. Under the Biden administration, I think we'll see, they're going to look at the blueprint that Europe did, because they're a little further ahead of us in the adoption of the Paris Climate Agreement. And then we're going to see some pretty significant changes. And I think at the same time, another thing that's hard to overstate, I think that as we look at millennials moving into their peak earning and investing years, I think there's a marked shift in their approach to investing and a willingness to perhaps not seek just the absolute best investment outcome. They still want a good investment outcome, but it's critical for them to also have it be a responsible outcome and a good outcome for society as a whole. So the combination of regulatory change, societal shifts, I think are going to really start to see more momentum. And that's why, the industry is really trying to ramp up in terms of getting offerings to prepare for these products that the next generation is going to really want in their portfolios.
I mean, clearly the administration's infrastructure plan will go through in some form or other, if there's that much support, and that's going to contribute towards a stimulus and also a lot of green infrastructure, in the sense that transport and energy infrastructure is going to be at least a source of deals to become related to green bonds. Lisa, a question to you. If you're in this unusual situation, you're an enormously significant institution in the American capital markets. I should say Australia. I spent 4 months in Australia this year. I haven't gotten over the joy of being able to go to the beach and not worry about COVID for a few months, but I'm back in London now. You're looking at the market from a very unusual position, given the scale and size of Fannie Mae. What would you be saying to the administration would be useful things to do to drive this transition, for example, in the property market going forward? What could they do, given that their ambition to fulfill their stated ambitions?
Sure. I think, interestingly, one thing I would say to what Patrick had said earlier is I feel like anecdotally here, the focus definitely seems to be more on climate risk, not just on green bonds as a whole. So both the SEC and our own regulator, the FHFA, had an RFI looking for climate risk, climate disclosure input. So I think that is where we are really feeling that first layer of focus is on the risk component of climate. But I would say, we have the benefit of not being the first movers. And so the idea is, can you look at existing standards and taxonomies and find the ones you particularly identify with and that are already out there setting a market standard? And can we learn from the EU's experiences, positive or negative? You had mentioned, the couple of recent developments. I think we're still on the EU taxonomy concept. Is it right to go, a yes/no binary green bond idea? Is that really something that we're comfortable with? And then I would say, from our perspective and looking at what needs the most help right now, honestly, I think it's data. To the point earlier about apples to apples, it's very hard to make an apples to apples comparison if issuers aren't providing the same data across different asset types. And so availability of data for us, utility data is probably the first place that we're interested in. Can we get raw building data? Especially if you think about the multifamily world where you're talking about apartments, can you get apartment level data, since most tenants are paying their own energy bills? So these are developments that I think only regulation will really improve. We've made a lot of strides without regulation, and largely, I think, because of investors and their push, like Amundi and BlackRock kind of pushing folks to do more. But I think now we're at the next stage of really trying to figure out the regulation is coming. Can it be a power for good, and hopefully, continue to build the market?
I mean, an example you've said to me before, I hope you don't mind me repeating it, that in the Energy Star system, there's a lot of data swimming around, but we can't get access to it for various reasons. The work could be done to try and make some of that data more available, right?
Well, really, and the Energy Star system was our proxy for raw data, because we don't have, what the tenant paid, right? What we have is an Energy Star system. We worked with the EPA to do a benchmark exercise, because what folks need, if you look even at the EU taxonomy, one of the categories is, top 15%. Well, how do you become a top 15% building if you don't have relative performance data? So the Energy Star from the EPA is a great way to, have that raw data go in on the backside and then create this 1 to 100 score that we as issuers and investors can look on this side to see, hey, where is that relative performance metric?
So for someone from the Department of Energy on the line, you heard it here. Great idea for you to consider. Okay, we need to move on. I want to talk about sovereigns, and this question to you, Bradley. You've seen a lot of sovereign issuance around the world, and we've got Canada saying they're coming to the market. Are we going to see a T-bill, a green T-bill? What's your hunch?
I think absolutely, because I think when we look at strategies and you want to have an impact strategy, typically a lot of times a threshold would be that half of the portfolio would be addressing these impact considerations. And when you think about the bond market in the U.S., you think about the Bloomberg Barclays aggregate is sort of the S&P 500 of the bond market, and the vast majority of that is going to be treasuries and it's going to be securitized. So right now we see a lot of ESG ratings for the corporate market, we absolutely need to see it flow through, not just the specific Fannie programs Lisa's talking about, but almost all of the agency programs, all of the government programs. So I think absolutely there's going to be a push because there's just demand in the market for this type of security. Then the question will be, will there be a differentiation of a green premium in these areas as well? And that's, with the U.S. government already being a risk-free rate, could there be an extra premium? And I think the answer is probably yes, because the demand from the market.
Sorry. Repeat that, Bradley, quickly.
I think
there might be a premium.
There could be a green premium for a U.S. government bond because of the demand of these impact strategies. There's going to be demand for the paper to meet the needs of the strategies, the way they're going to be constructed. So I think that's highly likely as we move forward.
I would just add, I think the sovereign space is one of the areas that we've seen considerable interest and continued growth with some of our recent second party opinions, most recently for the UK, Italy, as well as, Chile, Mexico, Ecuador, for instance. But interestingly, and this sort of touches on the point Bradley made earlier about kind of the new generations of investors and the appetite for engaging and participating in investment opportunities that address climate change and other critical priorities. There's a retail element to the UK gilt program, which I think is an interesting development and innovation that certainly reflects that kind of interest.
Okay, so all of this sounds like it's worth taking a bet on this happening, but of course we'll have to see over the coming year where it all goes. That's a sovereign space. It is worth noting for our listeners that sovereigns is the story of the green bond market over the last year. There's been sovereigns, as Bradley said, Italy and so on have come out, a lot of sovereigns, and the European Union is about to come out for 225 billion euro program of green bond issuance. So we're getting volume, we're getting liquidity, and of course we're getting some new benchmark pricing as a result of all of that. So an interesting area. But let's go back to the domestic market in the US. We haven't seen the corporate issuance at scale in terms of a ratio of green corporate to the corporate market that we've seen in other markets, Europe, even China, or even Japan, which is actually growing quite fast. What do you think the barriers are, and are those barriers changing the current political environment? Okay, maybe Bradley, I can start off with you, and then look, anyone who wants to have a go, put up your hand.
Yeah, just a quick comment. I think it's a little bit of the chicken or egg, as I had mentioned. The amount of impact strategies that are out in the market is still relatively small. And I think the other thing you have to remember, when you're buying a corporate bond, you're getting paid an excess spread, in effect, over the risk-free rate, which is the Treasury. And that compensation is for the risk of default at some level. And obviously, for a Microsoft bond, it's going to be extremely low premium, being AAA rated. And if we get into below investment grade, et cetera, the premium increases dramatically. So I think it's when you start dealing with then what, with the green bond as well, are people going to pay up when there's still the primary risk is still to make sure that the credit doesn't default? So I think that it's the combination of that a little bit with the fact that we don't have enough of those impact strategies. But like I said, I think this is going to change very quickly over the next couple of years. I mean, for example, one of the things we've been doing some research on this is, looking at a net zero type of strategy and looking at, announced carbon reduction targets. And there's still a surprisingly large number of companies that don't have an announced carbon reduction target. And I think that if you take these strategies as net zeros and you eliminate those companies, pretty quickly they're going to be made aware, well, we're not going to buy your bonds because you don't have an announced target. And of course, an announced target can be science-based or just a corporate level, but it's the first step. And so I think that we're just still early stages. I think we're getting there, but it's just going to take a bit of time.
This is a sea change underway, isn't it? Patrick, are you seeing that in terms of your huge US client base?
I mean, we certainly are seeing a pretty broad-based interest kind of across the board in terms of engaging with us on the second party opinion side of things and increasingly on sustainability ratings. I mean, I think, we've seen in the utility sector, for example, some important milestones. We've seen one of our kind of more recent marquee engagements was with energy. So there's no question the pipeline is is there. I mean, I think companies are at various stages of their ability to, engage and meet some of the expectations of the market in terms of disclosure and providing the information required. Especially as you look at, the sustainability linked space, for example, and KPI based issuances, having the infrastructure and the capacity to report on that and measure against KPIs and so forth. So I think as that takes root, and I think one of the factors that will contribute to that is some of the themes that we've been talking about, the policy environment, but also the demand on the investor side to not only have these investment options and to be able to allocate capital accordingly, but also policy pressure to increase disclosure and so forth. So I think it'll eventually come, which will hopefully make that easier for corporates and other segments of the market.
So you're pretty optimistic.
The figure and the volumes of what we're seeing certainly point to that, and I think I think this seems to be a unique confluence of factors coming together, both political and economic, and really sort of the stark headlines, to be honest, the human suffering that we've experienced through COVID, but also seeing fires, flooding, and so forth. So I think that brings a unique combination of urgency and focus that to me suggests that we'll continue to see robust interest and growth.
So for your listeners there, I think what you're hearing is this is going to grow. Let's just double check in the muni space and Lisa's space. Lisa, I know you're the elephant in the room, but you've seen your sister agencies, Freddie Mac, and in other countries too, start to look at this, haven't you?
Definitely.
Tell us a little bit about that.
No, I think, Canada have a very similar secondary market mortgage entity. They are working on a program themselves. Freddie has a very committed impact bond program, which includes their green and social and sustainable. I think it's not just in the agencies, though. I think what we all really want to see is the non-agency space kind of get out into the market. Frankly, to your much earlier point about, are we seeing superior performance by greened assets? That's hard to determine when you're talking about agency space, right? We have a very tight credit box window. These things are performing regardless generally of whether they're green or not. What we really want to see is if you're going to the CMBS market and you're doing other assets that maybe don't have the same credit box, are you seeing a superior performance from that green asset that has made the energy and water consumption improvements? Right? We're an insurance company. Basically, the idea is if you have a borrower willing to invest, it should be better performance long term. And so that's really what we want to see play out. And then I would say the second thing is really that climate risk impact, which is I think where a lot of folks are looking at is in resiliency and how to reduce the climate risk of your individual portfolio. So I think that's where you'll see some issuance or discussion or possibly new products.
Mike, the climate resilience part of it, of course, is something you've picked up. But just stepping back, looking at the broader muni market that you've been around in a long time, are you seeing this change? And we've seen quite a bit of issuance. Transport, BART, that goes into San Francisco, for example, has issued green bonds. Is this growing?
Yeah, I think so. I mean, I think investors are. I think it's coming probably from investors largely, and also rating agencies. Moody's, they're asking a lot more about climate resilience when they're doing their credit review, and I think those kinds of things, signal to issuers that they really need to ensure that the projects they're building are resilient, are taking into account sea level rise, et cetera. We were actually credited, it was listed as a credit strength, our sea level rise policy. We have a citywide sea level rise policy, and so that kind of signaling, I think, is really important.
I just want to ask you a little bit about your issuance program. You've always done quite a lot of post-issuance work, haven't you?
Right.
And as you've seen from Caroline's graph, post-issuance isn't as common. It's growing in the US as in other markets. I mean, is this changing? Do you find people asking you about your post-issuance reporting so you can give confidence to investors like Amundi?
Yeah, definitely. And we're putting a lot of energy into our post-issuance reports. We're aligning our impacts with the UN SDGs. We're making our environmental impact reports available. This is all on our website. And we're also looking at ways to improve the access to data. This is kind of going back to Lisa's point, I think, is that there's tons of data available. Right now, we're having to go back and talk to the project engineers to get the information. We're trying to do something that's much more, kind of proactive, where the data is being collected along the way. And so we've engaged a academic team to help us build a screening tool so that all of our projects are screened for climate resilience, climate mitigation, as well as social inclusion goals. And then that data will be carried through all the way to the end, and hopefully we'll have it'll flow into our reports, and we'll have a dashboard. This is the goal, is to make a super transparent project impact platform, really. And and this is really, investors are asking for this. So this hopefully Amundi, hopefully you agree, Bradley, this will be valuable. But we've heard that, and yeah, I think we have all this information. So why not make it available?
I would just make a quick comment on that. Yeah, I agree 100%. I think, we're used to, Patrick and Moody's constantly monitoring credits and the credit quality in terms of the rating, but then these green bonds get issued and they've qualified, so obviously they're labeled as such, but then once the issuance occurs, there's really generally no post-issuance follow-up. And I think that the whole market wants to get a much better understanding. I think there should be a requirement, and maybe it's even an additional rating to make sure that that the bond can retain its green status through the verification process.
If I could just add to that, I mean, stepping back, our goal is to build assets, invest in infrastructure that is going to be climate resilient and meet our mitigation goals. Of course, we have a huge opportunity to address social inclusion issues. And so we want to make sure that all of that information is made available and to investors.
Yeah, and touching on Bradley's point, I mean, I wholeheartedly agree, and I think hopefully the market moves in that direction in terms of post-issuance reporting and verification and so forth. I mean, I think this begins to touch on the subject of greenwashing that you alluded to earlier, and I think our methodology and approach to the second party opinions, and for those of you familiar with VE, formerly Vigeo Eiris, which has a long history of providing second party opinions, we acquired them in 2019. And one of the unique aspects of the approach to the SPO is it takes into account not only alignment to leading standards, as well as SDG the SDGs, but it also does take into account the entity level profile and contribution to sustainability. So it looks at the ESG profile more broadly of the company or entity, and its commitment to policies and frameworks and practices that promote, support sustainability and have coherence. So I think that's one way also to hopefully ensure greater understanding and insight, not just of the labeled bond or debt issuance itself, but the bigger picture for investors and other market participants.
We need to wrap up, everyone. Lisa, do you want to dive into this question, or shall we?
No,
keep going?
no, go ahead, because it's a very long answer. So go ahead.
Well, you've done a lot in post-issuance reporting.
Well, because we're commercial, but I think if you think about your personal mortgage, do you want monthly reporting to your lender on what you're doing? It's a challenge. It's a really big challenge for AssetBack.
Yeah, absolutely.
Can I just make one brief point,
Yeah.
though, is that, if we're going to get our arms around our impacts over the long term, we really need to be reporting out on this information so that we know, as a city, are we meeting our goals? As a state, are we meeting our goals as a country? So we need to be able to get this information. I think this post-issuance reporting is going to be really key to that.
One of the things we've tried to do in the work on developing taxonomies around the world and in climate bonds is to clarify what counts and to identify reporting metrics that aren't too complicated and that are arm's length. So you just say, that's the standard, I'll report against that, and that will do the job, which doesn't stop you doing more reporting if you can. And I note that San Francisco Public Utilities has got a lot of reporting metrics, but for folks where the transaction cost is high, there's a way in. We can keep it simple. you can participate in this market, and then the likes of Amundi can still fit into a larger framework, even though they might be particularly keen on the extra reporting, depending on the story they're telling their clients and the narrative they're running about their funds. But that simplification through taxonomy, or through, sorry, I shouldn't use the word taxonomy, it's got TAX in it. I've got to say simplification through green definitions, clear definitions, which is what we hope to see will come in the US as it's coming in other countries as well. Look, we need to wrap up. Great panel, folks. I'm going to ask you for a takeaway reflection about the prospects and your thinking about this market. I'll start with Lisa, which is, the hero of the American market. Lisa, your thoughts?
Super over exaggeration. So I think, especially for the folks that are on for North America, I think the issue I would leave you with is there are existing taxonomies for both green bond processes and the greenness of the bond. So they do exist. Please review them, be familiar with them, and then we can fight about them afterwards. But I definitely feel like there is information out there, and find it and understand it, and then bring that to your issuer or your investor and have that conversation.
Mike.
I would just say, if you're an issuer and you're debating whether or not to issue green bonds, please do it. Get off the fence. It's not that hard. It's not, the reporting requirements are not too onerous, and there's actually a lot of flexibility within what you report. So join the market.
Crisp and clear. Our funders, our sponsors, our partners in this report have been Moody's and Amundi. Thank you so much for your support going forward. But a final word, Patrick first, and then we'll go to Bradley.
Mike made it easy for me to urge the just do it and go for it, and also their partners like us to help make that process easier and help provide that greater transparency. And in all seriousness, I think we've talked about data and how important data is, but it's also very much about engagement and having dialogue and sharing insight and views on whether it's green, social, or sustainable. So having the dialogue like we are here, but more individually, I think is critical as we move forward.
Bradley.
Well, green bonds have been around for quite a long time, but I think we're now at a point where we're hitting the tipping point. We're adding social, we're adding sustainability, and we're adding market demand. So we're getting to the point where we're really going to see, I think, a massive change over the next 5 years in the industry, and Amundi is going to be there to provide the solutions for our clients.
Caroline, a last word, the author listening to this.
Thank you, Sean, and thank you to everyone. I really, really enjoyed that discussion, and as always, learned so much. So, our work obviously is to give a market to issuers so that they can easily find funding for their transitions to a low carbon business model. And the United States Treasury, you are the most visible bond issuer on the planet. The Green US Treasury bond would be the single biggest event in the history of the green bond market. And it would certainly get the market going and raise visibility and awareness in ways that we can only dream of. So Janet Yellen, come on, I'm talking to you now. Show us your green, please. We're waiting.
Well, that's one hell of a call to arms there, Caroline. Thank you so much. Thank you, listeners, for joining us in this webinar today. This is being recorded. If you go to YouTube and just search for Climate Bonds Initiative, you'll find it. Give us a few hours to post it, or you'll be able to get it through our website. Thanks again to our supporters, Amundi and Moody's, who've made this project possible. Thanks to everyone in the US market who has been a pioneer, a driver of this growth, including our great friends, Lisa and Mike at Fannie Mae and San Francisco Public Utilities Corporation. But there's a few of them. Read the report to find out who they are. We have a big challenge. We've got to get emissions down. Whoa, super fast. And get our societies ready for more heat waves like we're currently experiencing in the Northwest, because climate resilience, as you've heard from Mike and others today, is a big issue now going forward. There's work to be done, but luckily we know what to do. It's not rocket science. It's just got to be applied, and we have the capital. the green bond market is at the minimum proof that if we do this, the investors will jump in, and there are benefits to doing it, from stickiness to investor engagement to maybe even a little bit of price benefit you heard today. Who knows, price benefit on a US green gilt. Whoa, wouldn't that be incredible, Bradley? Let's just see, that'll drive the market. We have the opportunity to act. This is one of the ways we can act. But we have to do it now because time is short. We have a few short years. The US target of 2030 is a reflection of how little time we have to act to avoid more catastrophic experiences than we're currently having now. All of us working together could do it. Hey, because we've got the money and we've got the solutions. So good luck, everyone. Good luck in creating a future that provides sustainable returns and sustainable futures for our kids, for our families, for our friends and loved ones. Thanks for joining us today. Speak to you again soon. Thank you, everyone, for being on the panel today.